Okay, quick Monday morning radar update. So, gap down today. Let's just buzz through these markets as we do. Transports, yeah, I've thrown a baseline in there. Base with supply is what I would call it. One market does not make a trend. There is no breakout. Blah blah blah. We're just noting the the okay price action. I think that's the best way of putting it. Dow. So I'll just let's just reverse this up a couple of weeks and let's just. It's always the same, when the markets break down, they break some pretty important levels. I know if I get pulled out of my trends, my primary trends, it takes, there will be whipsaws, but it does take a real move is probably the best way of putting that, to actually pull me out of these things. So, pull me out of the primary trend. So let's just as the market pulls you out of the trends, out of the winning trades, out of the losing trades, whatever, the weighting gets lower in the account. The less risk on the table, anxiety levels drop. The market keeps dropping, anxiety levels keep dropping. You get pulled out of these trades and it pulls you to cash. It's the right thing to do. Mute the browsing PC. It's the right thing to do. You want to be making the best sane decisions when the market is at its, as the market gets worse, decisions become easier to make because you're not emotionally invested in these things. So, that started to play out in this leg here, this first leg, and then into this leg. Technically, it's about bouncing to supply. Been banging the drum on it. What would change that? Well, probably time would change that. Basically, I'll just reverse that up as well. The way I was coming at this was the next bear leg is going to give us the best clue. I think that's the best way of doing it. Let's not get, at the moment, we've got this frothy move, and the big picture of the market is, basically this correction we're in has only just blown the froth off the top. It's literally just blown the froth off the top of the market. It hasn't really made, there's no destruction in sort of. Well, there is destruction out there. If you go looking for it, there's definitely destruction. But in the stocks, but in the markets, there's no destruction yet. So, looking at stocks and thinking they can't go lower, if you see destruction in the markets, you'll see a different ball game in some stocks. That it is what it is. So, these markets have been basically just going sideways for the last 12 months in the Dow, and it's getting more volatile, and that's kind of not a really good sign. But, we take this one day at a time, and this is the best market to show it. We get this break of trend in the S&P, and this move here, you wouldn't believe how many times I get people sending me messages going, but you've not bought this, you've not bought anything. It's just, it's just froth, it's just a reaction back into the range. It is what it is. Go looking for the stocks to buy, even if you have got money to allocate, and you'll probably find that the stocks what are actually rising, there's always stocks to buy if you buy beaten up, junk, whatever, but, good company, a good price, and the trading and the trading 52-week lows. There's always something, there's always something to buy, isn't there? If you're bottom fishing. But us who wait for for stocks to actually prove they are rising. The technicals will catch all the rising stocks, and the technicals aren't catching any. We're catching them off the surface. Think of it as a fly fisherman. We haven't got a sinking line on. We've got a floating fly off the surface, and if they're not coming to the surface, we're not going to see them in our screens. We'll see them in the pullback screens, just throwing sort of reversals off pullback areas, but they're going to be kind of a lower hit rate when the market's against them, basically. So there is a time and a place for buying pullbacks, and it's in a good market, really, not in a bad market. So this was froth. The market's proving that now. It could turn into be an interesting level here. We want to see how the market reacts to the first real reaction, and the first real reaction was here on this leg, but this is a bigger pattern viewable on a weekly chart. So it's a little bit more meaningful to me to see how it plays out on this. Russell's obviously gonna be the weakest. It is what it is. Riskier end of Russell's leading. Oh, righto. The DAX, looks like a bear flag to me. Doesn't mean it has to. We'll take it one day at a time. This is interesting. Just chatting with my friend in chat this morning, and the old metals story, and the inflation hedge and all that kind of. The end of the day, stocks will trade like stocks, and the FTSE 100 is getting smashed now, isn't it? On the back of on the back of everything today, but all the metals stocks are being whacked today. Guess what? They're just trading very normal action in quite a volatile way at the moment, actually. But we know there's a story to pin on every move. But if you take the stories out and just, if you trade on stories, you got in the metal stocks at exactly the wrong time. You couldn't be worse timed for those efficient ones, those efficient main market ones especially. So if you trade on the back, you wait for the story. It's always a great story. Battery metals, what happened to that? It's always a great story. It's usually the worst time to get invest. I've been sat here a long time. Sometimes a story, like how many false dawns the oil stocks have had. I'm always going to, be on the sort of in the camp that it's probably just a bounce, whatever. I'll trade oil stocks on my own criteria, as I always do, and then sometimes it does get a sector move. But relying on the sector move is a very hard way to do business. If you rely on the individual stocks, the best of the best, what have got a reason to move other than the oil's price, you're going to do better in that space. I will guarantee it. Don't hold me to that though. Anyway, let's get to the 250. So the 250, active high, lower high. We dropped through these two levels here. These levels here, we got a little bear flag, and then it got whacked, and then back up into mean trend. Let's see how this plays out. Small caps, same. So today we'll go and have a quick look what's in the volume screens. I've left it a little bit longer, as I tend to on a Monday morning. It's 11:30. We should have traded 41% to be on average volume. I'll just I'll just highlight these two stocks. Jet 2, ugly action. I tend to avoid anything aviation based. And we'll put that in the small caps, 41%. And there's an extremely good lesson in the way I screen the markets every day. if you don't see anything in these screens, you're not going to get sucked into a lot of froth, you know, buying the dip and then averaging down. That's how you destroy. Just throw it out there. I don't think anyone who's ever pulled me for being, beating the averaging down, basically, is the way to disappear. And I don't think anyone's come back at me after a bear leg and said, told you averaging down works, because they always disappear. Always. When the real market correction comes, you don't see them again. And the other problem is when you're a full-time investor, trader, you can't just go to the money tree and keep plucking off, £50 notes. It doesn't work like that, if you're dollar cost averaging, it's a different game. You can, and I do that on a pension, but you run out of money very quickly averaging down. You also go bankrupt very quickly. Empty the account. So yeah, there's nothing to see. There really isn't anything to see. I spend my day working on. I'm working on the new spreadsheets I'm building, just to add all the sort of methods I use for trailing trends and methods what people can tune for their own use. And I'm spending my time in this market just working on those and other things behind the scenes for my own sort of site. So, time is well spent when the market's bad. It really is. Coming back to the markets just because they're on, they're good again. You don't want to come back to markets and then start inventing a methodology. Another thing is people say, oh yeah, you change with the markets. So basically what changing with the market does, it basically throws you on the time frame spiral. Every time something long term doesn't work, you end up shorter term, and then when the market makes that real move, you trade all these short term positions. And then you look back in 6 months, 12 months, and you've missed out on all that profit. And a lot of people did that after the pandemic. We rode those trends out. We've rode them out, and that round trips. Those trades are completed, compounded on the account now. So you've got to sort of the better the more work and the more solid sort of foundation you have for what you're going to do when the markets come back online, to make it easy to make decisions, it's just going to pay dividends in the future. It really is. Okay. Soapbox Monday.